You are right now looking at live shots from Cape Canaveral, Florida, here in the United States. Blue Origin, the space company founded by Amazon co-founder Jeff Bezos, set to launch its New Glenn rocket, an attempt here to prove to NASA that it, too, can actually play in the space race that has been dominated by Elon Musk's SpaceX. But right now, what we are looking at is a rocket still on the pad, a launch that, at least for right now, has been put on hold. I'm Romaine Bostic alongside
Katie Greifeld, that is my name. Watching this rocket right now, we know that this specific launch was going to be attempted on Sunday and Wednesday. Both of those attempts were delayed. This would be its second mission for this rocket, Romaine.
Absolutely here. And of course, we will get back to financial markets, taking a big dive lower on the day with the S&P down almost 2%. But as we focus in here on this rocket and really more importantly on the more holistic story right now about the race to space being led by private companies, we now see potentially the product of that on the platform. We're joined right now by the co-host of Bloomberg Tech, Ed Ludlow, who has been following this story for quite some time. And Ed, maybe if you could kind of set the scene for our viewers into why this launch, or potential launch, I should say, is so significant.
Yeah, you set the scene well, Romaine. You know, in commercial space, the context is that having more commercial providers that can demonstrate commercial viability and reusability is a great thing for America to have. This is only the second ever attempt for the New Glenn system, which has been years in the making, to try and put payload to orbit, this payload destined for Mars's atmosphere, which we can get into later. But Blue is yet to demonstrate the reusability part, yet to re-land a booster. They had one attempt in January, but reignition failed. And so the landing of the first stage booster failed. Just for what it's worth, you're seeing on the screen that we're at T-minus 20 seconds and a hold. Very normal in this launch procedure. From this point, everything is software, autonomous systems, and sometimes they give themselves room to catch up, but we just don't know what's going to happen at this stage.
And just remind me, Ed, I mean, this was a rocket that was actually supposed to take off the other day, but it did not happen. Why was that initial launch scrubbed?
Initially Sunday, simply because of weather. You know, you're looking at Launch Complex 36, Cape Canaveral Space Force Station on the Space Coast, where clouds are an issue. What you're now also looking at right there is the landing pad, where they will hope that the first stage booster will land on successful mission 375 miles offshore. That gives you a sense of the complication in doing something like this. We also thought we might go yesterday, but curiously not within Earth's atmosphere, but outside of it, there were some solar flares which impacted the ability to go. So maybe today, maybe on Bloomberg The Close.
Maybe on Bloomberg The Close. Of course, we're going to be following this. And Ed, of course, we were looking at that floating platform. As I understand it, that is in the Atlantic Ocean. And to your point on reusability, for those who don't follow the private space race that closely, is that the key metric here, demonstrating that this can be reused and land successfully?
It is. I mean, the stats and specs of the New Glenn system make it comparable to SpaceX's Falcon 9 and in some sense Starship. Both in the Falcon 9 context, SpaceX dominates the activity of all commercial launch from Earth and payload deployment in space. They can reuse the booster time and again. You know, Blue Origin, frankly, is behind. The original goal for 2025 was to do maybe 5 launches of New Glenn. This is the second one, and they're hoping that they'll be able to reuse the booster for the first time. But as we talked about on The Close so many times in the context of SpaceX in particular, if you can get reusability of the first stage booster, it changes the economics of the launch system and therefore lowers the bar for those that want to have payload on board. Now, in this case, it is a NASA and public sector funded mission to put 2 satellites into Mars's atmosphere for atmospheric study. But you could imagine that if the cost of taking a ride on one of these systems and the competitive marketplace of having many types of systems improved, then that lowers the barrier to entry for all kind of payload or small sat makers who want to put something into space.
Right. Well, Ed, that's really interesting. I mean, to your point that you think about what this rocket is carrying, it's NASA's Escapade mission here. And we talk about the private space race all the time, dominated by the likes of SpaceX, dominated by the likes of Blue Origin, especially if they pass this test today. But what is the interaction, the relationship between these private companies and with NASA and sort of the government-funded missions here?
Yep. Yeah. So this is critically important right now where we have essentially the administrative position at NASA vacant. Jared Isaacman has been re-nominated to do it. But there is a philosophical tension between the goals of this country, the United States of America, through NASA as an agency, of whether we want to focus on projects around the moon or whether we focus on projects around Mars. How that's played out in recent weeks is, as we started this conversation, having different launch providers and different technology platforms is a good problem to have. It creates competition, and that means that, you know, contracts are awarded more competitively. SpaceX dominates that right now because it's the only one that can demonstrate the reusability. But in Blue's case, believe it or not, their backlog for this program is in almost $10 billion. So the commercial opportunity is there too.
All right, Ed Ludlow there. Ed, stay close by here. We are going to keep an eye, of course, on the potential for this Blue Origin rocket to take off today. A hold right now. Of course, that could lift at any moment, and as soon as it does, we will get back to that. But this is the close. We are counting you down to those closing bells. So we do want to check in on the markets real quick. Katie Greifeld, we started off the day. It looked like a relatively flat day for markets, but over the last couple of hours, we've seen markets really deteriorate. Right now, around session lows with the S&P down 1.8%, the NASDAQ down 2.6%.
Yeah, it's big tech sort of leading the plunge on the day here. You have to wonder what the catalyst is. We did get some Fed speak. We heard from Mary Daly, sort of echoing Jerome Powell, saying that December rate cut, it's not a done deal. And as such, you have about even odds right now that the Fed will cut rates this month. So maybe that repricing is what we're seeing show up in some of these measures of risk appetite. Absolutely.
Volatility elevated here on this Thursday afternoon. Let's bring Steve Quirk into the conversation, the chief brokerage officer at Robinhood Markets. He joins us here in studio too. Steve, great to see you here.
Nice to be here. Thanks for having me.
I want to talk a little bit about the volatility we've seen in the market, which to a certain extent I would think is good for your business. But I am curious just as to what you're seeing with regards to client activity. Have they really been trading around these big events, whether it's the shutdown, whether it's the tariff conversations, and all these other big catalysts that we've seen over the last few months?
Yeah, I think we've seen, so we can measure that a variety of ways. One is just, are they depositing more money, putting that to work? What are our equity volumes or option volumes, crypto, margin balances? And everything's been really strong. I mean, we saw a really strong dip buying post-tariff, right around the tariff time. And now we're seeing sort of customers rebalancing. So in other words, the names that are the most popular were the ones that were down 30, 40, some even 50%. And they were aggressive in pursuing a buying activity there, and as they've appreciated, they've rolled out of those and into some of the names that are lagging a bit. So, but we haven't seen customers really being affected by the shutdown. I mean, we haven't seen behaviors change dramatically as a result of it. Yes.
Yeah, I'm curious too about what sort of types of assets people are utilizing, whether they're taking long positions, short positions. I mean, Robinhood is obviously sort of broadened out into well beyond its roots here. I mean, what are they gravitating to most? Is it still just buying equities?
It's straight buying equities, but what tends to happen when we see bouts of volatility, a day like today, you will actually see fewer individual names being traded. You'll see more broad-based indices. And I think what happens is customers say, I have conviction that there may be a bounce, or I may be able to take advantage of the market rebounding, but I don't have as much conviction on individual name, which it's almost like a safety play, if you will.
Yeah, that is really interesting. And I wonder, how they're buying the broad index. I mean, is that expressed through ETFs, for example?
It's ETFs, it's broad-based ETFs. So the SPDR, the QQQ, IWM, all the broad-based ETFs, we'll see higher volumes on days like this when we see spikes in volatility and movement like this.
Yeah, certainly. You take a look at the S&P 500, the NASDAQ 100, sitting near session lows right now. Also, I mean, keeping the conversation with the ETFs, you have the broad-based indexes, but you also have a lot of inverse funds as well, a lot of leverage funds as well. And I wonder what activity looks like there and whether you're seeing any trends emerge.
Not really on the leveraged instruments. They aren't as properly used because we do have, futures trading and other instruments which can permit people to, take short positions or hedge a portfolio, which is kind of what leveraged instruments are designed to do. They're not meant to be held because they rebalance so frequently. So we don't typically see an extreme amount of use even in volatile periods.
All right, Steve, we have to leave it there, and we have to get you back on a day where there's not a rocket competing.
Let's go the other way the next time I come here.
Right, to the moon, as they say. Steve Quirk, Chief Brokerage Officer over at Robinhood Markets. Katie.
And we're keeping an eye on the broader markets, but also on shares of Cboe, which are on their longest winning streak since 2019, fueled by optimism around the trading platform's return to its core options business. We spoke with Cboe CEO Craig Donohue earlier today about the strategy refresh, prediction markets, and whether more M&A is on the table under his leadership. Here's part of that conversation.
We just have such, dynamic growth in our core business. I want to make sure that all of our people are focused on capturing all of that growth, making sure that we're facilitating, more distribution, more access, more customer onboarding. And so that's our focus. The other focus is, paying attention organically to growth outside of the core, and the things that we're interested in there are event and prediction markets and digital and crypto and futures markets. But that's all stuff that's not very capital intensive and things that we can do that are within our so-called sweet spot in terms of our talents, our expertise, our platforms, and our customers. We're not really focused on mergers and acquisitions right now.
Yeah.
If there was something that was strategically and financially compelling, would we look at it? Probably, but it's not really a priority.
Let's talk a little bit more about prediction markets, one of those areas where you're looking to grow organically. We've seen some of your competition, of course, make big moves, big investments in that space. And I know that it's an area that you identified, especially on the earnings call, as a potential opportunity for growth for your business. And I wonder what the potential timeline is there for realizing some of that ambition, given that this space does seem to be moving quite quickly.
Yeah, it is moving quickly, but at the same time, I also think it's still early stages. Our focus right now is on our own organic efforts, which I hope will come to fruition in the next several months. I want to make sure that, we develop our own products, that we list and clear them on our own exchanges and through our own clearing houses and clearing house partners. The way I think about partnerships is our distribution channel partnerships, and we've got, great partnerships with, a broad array of retail brokers and obviously institutional brokers as well. And so those will be the focus of our partnerships, and our focus will be different than I think many of the other people in the marketplace. We want to make sure that we're focused on financial and economic contracts, ones that are relevant to our core products, relevant to our customer base. I think in some ways I would say Cboe was actually the innovator in these kinds of markets. When we developed zero DTE options, we provided much more access to customers who are interested in shorter term contracts that have, most of them in the way that they trade, capped risk. So I view that as sort of an easy connectivity point as we focus on event and prediction products based on economic and financial risks. Those customers will graduate into our options products.
Well, Craig, just to follow up on that point, does that imply that you're not looking at sports games, for example, as you explore this prediction market?
Yeah, it's really not a focus of ours. I'm sure that, and I watch all this stuff, I pay attention to it. I know there's explosive growth there. I know that there's probably the potential to make money there. It's also fraught with lots of, litigation and regulatory risks as well. So that's, I think, for other people, but for Cboe, we're going to remain focused on things that have financial and economic implications, and that's where we're going to choose to, play.
I am curious about the scale back that we've seen with regards to some of the international operations, Australia as well, Canada, and I guess some trimming in the European business. There's been a lot of talk about a refocus not so much on the domestic market, but the idea that you can operate internationally with a footprint that is, to a certain extent, singular in the U.S. and particularly Chicago?
Well, just to say, we have a footprint that is global. I mean, we have offices around the world. We have sales, marketing, and education resources throughout the world, and that's the way in which we'll continue to try to globalize. We can offer globally relevant product. We have exchanges and clearinghouses in both the U.S. and in Europe. And a lot of the growth that we're seeing is in Asia Pacific. We have a lot of brokers that are interested in gaining connectivity to all of our markets. And so we're trying to drive growth by facilitating that. I don't feel that we need to have an actual exchange presence in a place like Canada or Japan in order to drive that global growth. U.S. equities are now probably 74% of global market capitalization, so everybody around the world certainly wants to have access to our equity and equity index and equity derivative products.
Well, Craig, to that point, one of the initiatives that you announced on your earnings call in this restructuring was that you're going to sell Cboe Australia and Cboe Canada. You're going to discontinue your U.S. and European corporate listing efforts. And then this caught my eye as well. You said that you would cut costs in your U.S. and European ETP listings business, which is interesting because this is an area where you've made inroads. You actually surpassed NASDAQ when it comes to market share of ETP listings. So give me a little more context on what cutting costs in that business means. Does that mean you're not going to pursue ETP listings going forward?
No, we're going to continue to pursue ETP listings, but one of the things we need to focus on is profitability also. And so, having the largest number of ETP listings doesn't always translate into the bottom line and profitability. So, I think the big takeaway in terms of, our cost reduction efforts is not that we're abandoning those businesses. We're trying to be more disciplined in how we grow those businesses and how we maintain profitability in those businesses. And so it's really a more disciplined approach. So rather than trying to do sort of 5 things or 10 things, let's pick the 1 or 2 things that we think have the highest potential to be valuable to our customers, drive growth in the business, and obviously create positive financial results. So it's not an exit. It's really a more disciplined approach to how we grow.
Craig Donohue had a long career at the CME Group back in the day. Now the relatively new CEO over at Cboe. When we come back, we're going to focus on one of the biggest decliners of the day, Disney. The share's down 8%. A closer look at the earnings and what really spooked investors. This is The Close on Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. We start off with Nike today. Wells Fargo raising its recommendation to overweight, boosting its price target to 75. The analyst says Nike is, quote, lacing up for liftoff. This amid revamped business strategies and better visibility on its revenue and margin outlook. A third straight day of gains for that stock. Next up, Booking Holdings. Wedbush upgrading to outperform, saying Booking remains the best positioned online travel agency and continues to gain market share. Nevertheless, the 4-day win streak snapped. The share's down 0.9%. And finally, Dollar Tree, a double downgrade to sell over at Goldman, a price target slashed to 103 from 133. The analyst, she says she's concerned about Dollar Tree's worsening consumer reputation and prefers competitor 5 below if you're looking to invest in the discount retail space. Those shares having their worst day in about 6 weeks, and those are some of our top calls. Meanwhile, let's take a look at Disney. Those shares having their worst day since at least April 3rd after missing revenue estimates and warning that expenses for the upcoming slate of movies, like the third installation of Avatar, could weigh on results in the first quarter of its new fiscal year. Joining us right now is David Joyce, Seaport Research Partner, Senior Analyst who covers this stock. And, we should point out, David, I was looking at the most recent quarter, and I can understand why investors would be a little concerned about the flatness we saw there. But they did guide going forward pretty healthy earnings growth. And I know some of that's going to be weighted to the second half of fiscal 2026. Is that why we're seeing the shares down so much today?
I think that you have a combination of factors that I think are all overblown given the broader market pullback. Now, it never helps that the top line misses in a given quarter, but their segment operating income was above our estimates. And they did reiterate some key growth metrics for next year, even though they are pretty broadly defined, of saying, EPS will be up double digits. Maybe it's just not as great of a double digit as it maybe had been before. But it is a market that wants some more instant gratification, and the back half weighted nature kind of comments really never helps the stock. And in the short term, when they do have some big films that people have been anticipating, Zootopia 2 and Avatar coming late in the quarter.
Yeah.
Really, based on how film accounting works, it's very natural for there to be an earnings hit in the short term because they have to expense the marketing for that film, but the economics flow from that later. So it really shouldn't come as that much of a surprise. But broadly, I think it is the fact that it's more of a back half weighted earnings recovery story, so to speak, is probably why there's been some selling today, but I don't think it's really changed the overall thesis.
Any concern, though, about the idea that at least in the most recent quarter, it looks like the only real growth we saw was in that parks, that experiences business, if you will, both in terms of revenue and certainly in terms of profitability. It's kind of like Back to the Future, when it was just seemed like this company was totally dependent on that parks business to keep the rest of the company afloat.
That is still the bright spot here. The experiences did match our revenue and operating income estimates in this quarter. And there's actually upside now in the guidance versus our estimates for the next year by saying that the parks and experiences and cruise ships will generate high single-digit operating income growth. We've been more in the mid-single-digit range, but that offsets some slightly less positive commentary on the margins for the direct-to-consumer streaming business, where they're saying that would be about a 10% margin business, and we've been at 12%. So both those are offsetting, but it is still, overall, the profitability driver. And if you do want to take it to a 30,000-foot view, the experiences does require people going to the parks and spending more year over year, and you do continue to have some of that fear of the state of the consumer, especially if we don't get some of the interest rate cuts that the market is now starting to be concerned about.
Absolutely, and you're seeing that fear sort of expressed across industries right now. David, one of the interesting notes coming out of this particular earnings report was comments coming from the CFO, Hugh Johnston, saying on Bloomberg Television that the board of Disney should be in a position to name a potential successor to Bob Iger by the end of March. There's a few different possibilities here. Folks have pointed to the entertainment segment. Maybe you could get a name out of there, but also parks and cruises. Where do you think the next successor to Bob Iger should actually come from in terms of leading Disney forward here?
I think for now the front runner probably would be Josh D'Amaro, who's running experiences, because that is the main profit engine for the company. But I would caveat that by saying that historically Disney's really relied on its CEO coming from more purely from the entertainment side. They did have a Bob Chapek in before Bob Iger, who had more of the parks experiences and not much in the way of the entertainment and creative side, and that didn't end well. So that might still lend some credibility to the notion that perhaps Dana Walden, who's running the TV side, really could be a contender. So I think it's still kind of up in the air. I don't think that there would be a co-CEO arrangement like you have at Netflix, and there's been some speculation on that. But I've also heard through industry speculation that it's also going to be an internal candidate. The company and the board has not been looking outside the company supposedly. So I think that's still going to play out, but I don't think it should be too much of a surprise to the market whenever the next CEO is announced. It probably would be helpful if Iger stays around as chairman, just to you just to kind of ride off into the sunset a little easier than we saw last time around, but we'll see what plays out.
All right, David, great to get some time with you on a day where Disney shares just sinking in reaction to that earnings report. That is David Joyce. He is Seaport Research Partners Senior Analyst. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. The Council on Foreign Relations Task Force on U.S. Economic Security out with a new report about winning the race for tomorrow's technologies and laying out some of the challenges to the U.S.'s tech leadership here. And you can see China certainly is well represented there.
Yeah, and a lot of challenges. And we talk about the big AI trade that's kind of consumed this market, and it really has exposed a lot of the vulnerabilities we have in this country. We talk about private capital's risk appetite, how that might be distorting things. And then, of course, the supply chain. I mean, like, let's face it, a lot of the sort of rare earths and other minerals that we need to kind of build out this technology, you know, China kind of has a monopoly on a lot of that stuff.
Yeah, and it's funny how we keep relearning lessons when it comes to the supply chain, of course, coming out of the pandemic and now in what is a trade war at this point. So let's discuss with two of the experts behind that report, Gina Raimondo, former U.S. Secretary of Commerce, as well as Justin Muzinich, former U.S. Deputy Treasury Secretary. Great to have you both with us. And Gina, I will start with you. Sorry, it's been a very long day. So we take a look at some of the challenges here. And as Romaine and I were just talking about, it seems like China is a common factor here when you take a look at some of the different issues.
Yes, good afternoon. Thank you for having us. China is certainly the common factor. In fact, this entire report argues that when it comes to critical technologies like artificial intelligence, quantum, biotech, we need to outcompete China. And we need to reduce our dependency on China so they don't have leverage over us. They're investing incredibly in these technologies, and it's important that we stay ahead of them. So, primarily what we're saying is that America's national security, keeping us all safe and secure, depends as much on leading the AI race vis-a-vis China as it does on tanks, missiles, and drones, and that's what this report is about.
Well, Justin, let's talk a little bit more about how a nation does that, how they compete and stay ahead, because you make the great point in this report that private capital tends to avoid quantum and biotech due to long time horizons. But you think about just some of the capital needs that are here, and it seems like the private sector needs to be an important component.
Yeah, the private sector has to be the backbone of it. And what the report argues is that the government has an important role to play in bringing private capital to these industries, especially in quantum and biotech, where the investments will pay off after many, many, many years. The government can help bring private capital into the picture for the U.S. We have the deepest capital markets in the world, the freest and most robust markets in the world, and with a small nudge from the government, there's a lot the country can do.
I am curious what you think, Justin, about some of the nudges that we've gotten from the government already. I mean, we have seen the government take stakes in some companies in this space. We've seen even prior to this current administration, the desire or the effort, I should say, to extend loans and other financing to some of these companies. Is that not what you had in mind? What more needs to be done?
Well, we're looking at a whole toolkit. And I think the administration is actually being very creative in their approach. I mean, you look at, for instance, rare earths. They just struck a deal with Australia. They're signing offtake agreements or price floor agreements with a variety of companies to develop rare earths in the U.S. So I think, the U.S. government has a whole range of tools at its disposal. We're talking here about national security, as Gina said. And when you're dealing with national security and making sure an authoritarian country cannot cut off the U.S. from vital inputs, it's important we look at all tools.
But, Gina, this brings up a quandary that I think a lot of investors have raised. The idea that so much of the United States' strength in producing things, whether it's goods or services, has also been about this idea that we kind of export that to a certain extent, or maybe people come here and take it. Obviously, with AI and the need, as Justin points out, to protect our national security, is that going to potentially limit just how far this industry can go if they're not able to, say, freely sell chips to China or share other information with academics in Europe or elsewhere?
Only at the very, very, very cutting edge, which is not new. You know, the U.S. has used export controls for decades to deny our adversaries, in this case China, in the past Russia, our very most sophisticated technology. And it only makes sense if we have sophisticated technology that they don't have, that they want, that they can use to modernize their military, then, you know, you cannot put a price on our American national security. And so the right thing to do is to deny China. But what we really want is for the world to run on AI rails. We want the world to use AI chips, AI technology, AI software, AI infrastructure to power their own AI movement and modernization. And so that's very much in the U.S. interest, and there's nothing in this report or in our policy which would restrain that.
And, you know, you talk about technological leadership, the role that the U.S. should play here. A lot of people talk about AI. That's one of the most urgent questions. But it's not just AI, right? Talk to us a little bit, Gina, about the biotech industry here, because we know that a lot of drug development that happens overseas. We know that a lot of raw ingredients are sourced overseas. And I wonder, you know, how you can keep a place leading when it comes to being innovative, particularly in biotech, if you start to try to pull back a little bit from the rest of the world.
Well, quite to the contrary, we do not want to pull back from the rest of the world, but we want to reduce our concentration and reliance upon China. So what the report identifies and calls out is that in the past 5 to 10 years, the U.S. biotech industry has become increasingly dependent on China, not just for clinical trials or low-end manufacturing, but increasingly for drug discovery and licensing of more sophisticated medicine. And if you look at that, we're increasing our dependence on China. 20 years ago, China produced a tiny amount, negligible amount of global biotech patents and IP. Today, they produce close to 30% more than the U.S. And that's the wrong direction. And if we need to diversify that supply chain away from China, towards our allies, towards the United States, so that we can make sure America not only leads, but can get access to the medicine we need when we need it.
With regards to the overall strategies coming out of this report, and I'll pose this question to you, Justin, this idea of talent, which is, I think Gina gets to, you know, there's been a lot of discussion about our education system, meaning, you know, secondary education, collegiate education, whether it's up to snuff for the new technological age. You layer in some of the immigration issues that are ostensibly going to keep some folks from coming to this country that would have contributed to that brain power. What's the strategy for addressing that long term?
Sure. Talent is a hugely important question. It's not one which we took up in this report. I would say what we're really focused on in this report is getting the private sector involved in making sure the U.S. wins, especially in some of these very long-term races like quantum and biotech. And I think if we get the private sector involved, talent will come to the space, because once you start bringing private incentives into the picture, talent can to some degree take care of itself.
All right, really appreciate you both taking time for us. Justin Muzinich is former U.S. Deputy Treasury Secretary, and Gina Raimondo, former governor of Rhode Island, of course, former U.S. Commerce Secretary. When we come back, we turn back to the markets, which continue to be on the back foot, 2 to 3% declines across the board on this day. But one stock bucking that trend, it's Dillard's, up 11%. We explain when we come back after the break. This is The Close on Bloomberg. A down day in markets, but an up day for the department store chain Dillard's. The share is up more than 10% on the day after delivering a handy, comparable same-store sales beat as part of its third quarter earnings report. Joining us right now is Norah Mulinda. Let's talk a little bit more here about what's been moving this stock. And I know a lot of people are looking to the retailers to kind of determine the health of the consumer. Let's start with Dillard's, obviously a regional, to a certain extent, department store, not necessarily in everyone's backyard, but they seem to be doing well. Why?
This one's super interesting, being that if you think about department stores, we've been hearing about the death of the malls, the death of department stores, no one's going in person, but Dillard's is up 70% year to date. So they're really flying here. As you mentioned, those comparable sales really in focus here. But what I'm hearing from analysts is the fact that they actually target a more trendy, younger consumer that has money, that's willing to buy more premium items, and that's where they're really doing well, especially as they think about their strategy and who they're targeting here.
Yeah, this is a fascinating story because you take a look at Dillard's market cap. It's now above $10 billion. That is bigger than the market cap of Kohl's, of Macy's as well. So talk to us a little bit about the competitive landscape as it stands.
So as it stands right now, I mean, we are seeing shares of Dillard's. If you look at the Bloomberg terminal, we are seeing it flirting with overbought territory right now. So that is interesting when you're kind of looking at the share action here. But as you think about it and the competitive landscape here, this is a company that doesn't really do a lot of those semi-annual sales. They have a really good pricing power here as we're thinking about the consumer. They have limited clearance inventory. I like to look through clearance. Apparently, that's not where their focus is here. They're really wanting to do full price sales, and that's where they're really benefiting here against the likes of Macy's or Kohl's, for instance.
Well, that's what I'm curious about, if we can extrapolate what we're seeing with Dillard's, with, say, a Macy's. I know we have to wait a few more weeks before we get their earnings. And then, of course, the other big department store chain with Nordstrom, of course, not public anymore, and for good reason. And I do sort of wonder, is this just a story that is very specific to Dillard's, or should we maybe start to look to the other companies as well?
I think it's going to be interesting to see what we get in these reports. I mean, we're actually going to be hearing from Kohl's later this month, and then also Macy's next month, or in December, rather. So we are really seeing whether or not this is going to be exclusive to Dillard's here, but what you are seeing them doing well right now is their full price model strategy. And the fact that they're not really doing all these discounts. Of course, as we're heading into the holiday season, you expect to maybe go to Macy's and get something, and maybe potentially seeing some sort of gifts and stuff for the holidays here. But if you think about Dillard's, they're not doing those price slashes in the way that their competitors are. So it's going to be interesting to see whether or not this actually trickles into a broader story.
Margins, right?
Right, exactly.
So. The other thing about Dillard's I noticed too is like they tend to kind of have certain markets to themselves. I mean, a lot of markets, they really are the only sort of big multi-line. Maybe there's a Target or a Walmart nearby.
Yeah, it's Midwest, Southeast, those sorts of markets. So. From where we're sitting in New York.
The heartland of America.
Exactly. The lifeblood of this economy. Norah, great reporting as always. A fantastic day for Dillard's. That is Bloomberg's markets correspondent, Norah. Mulinda, meanwhile, you turn to the broader markets. A great day for Dillard's and not for much else. The S&P 500, we're off of session lows, Romaine, but still down by more than 1.5%.
And it's kind of interesting, too. I mean, I really encourage everyone, if you have a Bloomberg terminal or really anything that pulls up, look at an intraday chart of what happened today here, because we came in today, there was a little bit of softness, but it looked like at some point around like noon, lunchtime, people just kind of just threw in the towel. And there was no real news. It just seemed a lot of people either taking profits or maybe just positioning for something else.
Or maybe it's Fed bets getting recalibrated, because certainly you're seeing a bit of a sell-off underway in the bond market. Coming up, we're going to drive to that closing bell, though, with Racquel Oden. She is head of international wealth, asset management, and global private banking over at HSBC US. This is The Close. Welcome back to The Close. We do have a scoop out of Thinking Machines Lab. It's the AI startup founded by former OpenAI Chief Technology Officer Mir Murati. Let's get to Bloomberg Tech co-host Ed Ludlow, who helped break this news. And Ed, we're talking about a roughly $50 billion valuation here, according to sources. And this is a company that was only unveiled in February, I believe.
Right. Yeah, approximately $50 billion valuation in what are early talks. Some sources told us that actually discussions have been at a valuation of a range of $55 to $60 billion. But given that this is a company that just did a seed round in July at a $12 billion valuation, it speaks to everything that is going on in AI right now, particularly in frontier or model labs. We can get into Mir Murati, but it was CTO of OpenAI, but also briefly CEO. In that fateful weekend that Sam Altman was ousted, and then ended up leaving in 2024 anyway. So it's an astonishingly fast development. But again, these are early talks, and sources saying that the deal terms could change, as is often the case.
All right, the headline right now, Marathis Thinking Machines and the new valuation in the latest funding round. I'm sure we're going to check back in with Ed shortly on some other issues as well, but we do want to get back to the public markets real quick as we count you down to the closing bells. One of the worst sell-offs that we've seen in about a month, and it seems to kind of flip a little bit on its head. I was told that once the government shuts down, reopens from the shutdown, things were supposed to be good, but we're looking at an S&P down 1.6%, the NASDAQ down more than 2%, and we were just talking about AI. They're doing no help, no favors to the market on this Thursday afternoon.
You know, to your point, Romaine, it could be a sell the news moment, of course, now that we finally have ended the longest government shutdown in history. I will say, if you take a look at the volume right now, it's not particularly elevated, maybe about 5% or so above the 30-day average. Certainly with declines like this, you might expect to see more conviction behind the selling as measured by volume, but not necessarily the read-through on this Thursday.
And you get a little bit of a sense of that, too, with a relative lack of activity in the Treasury space. Yields are slightly down about 2 to 3 basis points, but still a relatively tight, narrow range that seems to suggest a lot of people still indecisive about what's been going on or what might go on with the Fed. As we move closer to the closing bells, let's bring in Racquel Oden, Head of International Wealth, Asset Management, and Global Private Banking at HSBC U.S. And Racquel, I do want to start with the reopening of the federal government here in the U.S. And I know it's going to take some time before we kind of get back up to normal, if you will. It's going to take some time before we get the past data, if at all, to know what's going on. But I was told that government shutdowns typically, or the reopening from government shutdowns typically leads to a rally in markets. Should we expect that this time as well?
Yeah, like if history truly repeats itself, what we do know is there will be definitely short-term volatility, which is what we're already experiencing today, right? So we expect at least a 2% hit to GDP in the fourth quarter, right? So that's short-term volatility we're going to experience, but we do believe in the first quarter, GDP will rebound, right? Because government workers are back, the economy's back, and the standpoint of that GDP actually will probably be bounced back by 3%, what we're used to seeing in Q4. Importantly, to your point, though, what we do know is after government shutdowns, we tend to see a 13% rally 12 months out.
12 months out.
12 months out.
Okay. So I got a ways to wait.
It's not a ways to wait, but I'd say at 6 months, it's about 8%, 13% by month 12. Yeah. So the idea here is when we do have a government shutdown, we do see a rally a year out. So that is what history has shown us. But we have very unusual things such as AI and tech and innovation that wasn't here in 1976 when we are taking the history of when we've seen the government shutdown prior. And also you're starting to see some of these corporate earnings coming in as well, which would tell you we expect to see a rebound a little quicker. Obviously, Disney a little slow today, but if we think about all the corporate earnings, 82% of them have, beat expectations. Corporate earnings by the end of the year should be close to 12%.
Was that a good thing, though, the beats? Because I thought the whole idea was the bar was so low, everyone could beat. But you're encouraged by that.
I am encouraged.
Okay.
And the reason why I'd say that is when we take a look at corporate earnings overall, they've been up 12% this year. And we're expecting that 14% next year. So equity corporate earnings really strong. We are also still expecting that third rate cut. I know there's a debate going on about that right now.
Yeah.
But we've already gotten 2 cuts. We expect another third cut. And we've also got, great, we take a look at the credit on tax credits for corporations. You should see some additional exuberance in the markets.
Yeah. All right, we're in conversation right now with Racquel Oden over at HSBC US. If you're wondering why there was a rocket right next to her face, it's because we are awaiting the launch of Jeff Bezos' Blue Origin Glenn rocket. It's been delayed a couple of times. It was supposed to launch on Sunday, was supposed to launch yesterday, was supposed to launch just a few minutes ago, and now it looks like it's launching now. Let's listen in.
Lift off, detected. First motion. You're going to have cleared the tower. Pushing 7 good engines. 30 seconds into flight. Engine operating parameters continue with good at full thrust. Body rate response to nominal. 40 seconds in. End of roll strakes now level. 50 seconds into flight, continue to see good engine operating parameters, all set for
We're coming up here on max Q, maximum dynamic pressure. This is the hardest point on the vehicle when it comes to the pressures and the speed. We want to see
operating parameters continue to look good.
That max Q
Seeing
will
good
stand by.
TBC control, good MR control. 1 minute, 15 seconds in. Now passing Mach 1, New Glenn is now supersonic.
Supersonic! And we can hear the
1 minute, 30
roar
seconds.
rocket bars.
Engine operating parameters continue to look good at full thrust. Max Q, maximum dynamic pressure. 1 minute, 45 seconds in.
We are past max
All
Q.
7
The
V4
rumble
engines
is
continue to
real.
look good. Body rate's nominal. Seeing good control on MR and TBC. Acceleration profile nominal. Now passing 2 minutes into flight.
BE4 is unreal.
One minute remaining in boost phase.
All right, 1 minute remaining in boost phase. You heard our team say. Then we'll hit MECO, main engine cutoff. That's going to lead to a sequence of events. We will separate the first stage from the second, and that's when the first stage is going to begin its journey back home. We're going to see if we can land the booster separately. Of course, we will get the second stage off and going with the NASA Escapade satellites on board on their way to Mars.
Trajectory continues to look good, seeing good data quality coming down from the vehicle. Body rate response
Great to hear that. Good data quality.
All 7 engines continue
Looking
to look
nominal.
And you are looking right now at the tail end of Blue Origin's New Glenn rocket, a liftoff from Cape Canaveral in Florida here in the U.S. Its first NASA mission, a delayed mission, but one that, at least for right now, appears to be somewhat successful. Remember, we are still waiting for that booster to disengage and then re-land back on land, something, of course, that Elon Musk and SpaceX have shown an adept ability to do. Whether Blue Origin can now sort of catch up with them, we're about to find out over the next few minutes. Our coverage of this launch continues with Bloomberg Tech co-host Ed Ludlow. And I'm pleased to say also joining us is Clayton Swope, Deputy Director in Aerospace Security Project and Senior Fellow at the Center for Strategic and International Studies. He also worked at Amazon, particularly for cybersecurity public policy at Amazon's Project Kuiper. And Clayton, I want to start with you here. As we look and, of course, we wait for the ultimate outcome of this mission, maybe you could kind of give us a little bit of sense as to just the amount of time and effort that it has taken for us to even get to this stage where we're at right now.
Yeah, right. Thanks for having me on. It's been a realization of 25 years of work by Blue Origin and Jeff Bezos. This is the second time that Blue Origin has launched a rocket into orbit. They've perfected, you could say, suborbital flight. They've had a number of suborbital flights, and they'll be able to reuse those rockets. But this one is a test to see, can they reuse the first stage of a rocket of this size? So from a technology standpoint, they're going to show that they can do that today, hopefully in the next few minutes. And then from a business standpoint, you could say, hey, this is really showing that that 25 years of investment is worth it. This is the first paying customer for Blue Origin. It's a NASA mission to Mars and also a communications satellite from Viasat, so a company.
Well, Ed, talk us through what we're looking at right now. Of course, we're looking at markets closing on a big down day, but also in terms of what we're seeing in the sky. We know that we're waiting for the successful touchdown. Have we seen the two vessels actually separate here yet?
Yep, so we've had first and second stage separation, and just adding to what Clayton said, we're about 4 minutes away from knowing whether America has two companies that can successfully land and reuse the first stage. I mean, that's what it comes down to. That will happen at about the 9-minute mark, so there's 4 minutes of that to go. What you're looking at approximately right now and over the next 2.5 minutes is the engines on the booster conducting a re-entry burn as it pulls back.
I think we're having some issues with Ed Ludlow's connection. We're going to reconnect with him in a second. Clayton, back to you here on this. I mean, of course, we have to wait to see actually if that landing is successful and it sticks to landing. I am curious just about the viability, though, of catching up with SpaceX, given how much of a head start they've had on this. The idea that they've proven time and time and again that they can do this. Is what we're seeing today the proof of life for Blue Origin, or are we going to need to see more launches before we get more comfortable with them doing this more frequently?
It's highlighting for sure a different approach to spaceflight. We look at the Starship launch, and for over 10 of those, they were always baby steps towards getting that rocket that could work, and we're still not quite there. Keep in mind, this is only the second launch of New Glenn, and it's already showing that it's reliable. But you're right, that is something key that people want to see. If they want to put hundreds of millions of dollars of satellite on that spacecraft, they want to see that it's reliable. They also want to see that it's competitive on price. So it's really those two things that we're trying to see if Blue Origin can do. They can make it reliable, they can make it competitive on price. And it will happen over time. But the indications so far are that they're getting there, and they're getting there very quickly at this point. So you could say that exponentially, maybe we'll see that competition where we do have another company there that looks a lot like SpaceX that can launch just as much at just a competitive price point. And that's certainly a benefit to the United States. No other country has one capability like this, let alone two.
Right. Well, Clayton, let's talk about that a little bit more, about why it's important to have this degree of private competition, potentially two companies who are able to accomplish such a feat as this. We'll find out in the next few minutes. But you think about the interaction with NASA. Just talk us through the importance of having multiple companies who are able to do something like this.
Approach that NASA's always had, so has the national security community in the United States. We want to have a backup. We want to have resilience in how we get to space. If something goes wrong with one vehicle, we want to have another one. So for a while, we've just seen where SpaceX has grown to dominate that launch sector. So right now, if we have another launcher this size, the New Glenn, that will create a lot of opportunities for the military, for the national security community, for NASA, and also for companies who are doing business in space to have that second option. So it's that reliability piece, but also that competition on price and innovation and technology development that I think we'll start to see now once we have two viable launchers, heavy lift launchers.
Hey, Ed, I want to bring you back into this conversation, and I wonder if you can kind of take us back a few years. I mean, it's kind of hard to imagine. It's been about 10 years since SpaceX first successfully was able to get that booster back down onto the pad here. Talk a little bit about, A, what we're looking at, but more importantly, what comes next and what Blue Origin has to get right in order to stick that landing.
They have to get a fully autonomous system and their rocket science right. You know, this is a software-driven thing, and over the next 60 seconds, they either are going to or are not going to land that first stage booster. You just saw reignition of the engines of the BE-4s at the base of the booster, and its target, as it goes behind the clouds, is an autonomous landing vessel about 375 miles off the coast of Florida and Cape Canaveral, called Jacqueline, named after Jeff Bezos's mother. The point being to your original question is SpaceX has done this hundreds of times, literally, with a high concentration of that in more recent years, and has moved way past the point of validation of tech.
Hey, let's take a listen in here as it does appear that booster is now approaching the platform. And we are now getting live pictures here. We have been getting live pictures here of that Blue Origin rocket launch, but more importantly, it was less about the launch and more about the landing. You can see Katie Greifeld, the staff, they are cheering what does appear, from at least from my own eyes, does appear to be a successful landing.
Yeah, absolutely. Remember, the goal here was to see if whether the rocket's booster stage could successfully land on a floating platform in the Atlantic Ocean off the coast of Florida. It looks like it's done that. Look at that. It looks like it's intact. Of course, this, as we've been talking about, is only a feat that has been accomplished by SpaceX. But now we know we have two American companies who are able to do this and use these rockets potentially for later reuse.
Hey, Clayton, I'm just going to get your thoughts here before we let you go here. I mean, just seeing the enthusiasm of all those folks on the ground, in the control room, et cetera. I mean, what do you feel when you see something like this happen, particularly given that you do have a connection to Bezos when you were from your time at Amazon?
to me, I'm proud of the innovation that happens in America and American companies, of the cycle of creative destruction. Monopolists don't last very long in the American system. New ideas come along. There's competition on price. I don't know if we're seeing that now, and SpaceX is an awesome company, and they're going to continue to do great things. But it's always great to see someone who came along, stuck to an idea, and really brought it to fruition. In the case of Jeff Bezos and even Dave Limp, the CEO of Blue Origin, these are dreams they've had since childhood. And to see something like this happen after so much effort and work is just got to be really rewarding. But I also think it's rewarding for America, and just to see how our approach, that free market-based approach to innovation and development and business, really generates new ideas. And here we are, two companies now that have done something else nobody else has done in the world, way ahead of the competition when we think about it from a geopolitical standpoint.
Absolutely, and it is a striking image there, seeing the booster stage resting on that floating platform intact. Really great to, of course, walk through all the action with you both. That is Bloomberg Tech co-host Ed Ludlow, as well as Clayton Swope. He is Deputy Director in Aerospace Security Project and Senior Fellow at the Center for Strategic and International Studies. And we turn our attention away reluctantly from what's going on with rocket ships, and we have to talk about what a down day we saw in this equity market. The S&P 500 finishing close to its lows, really dragged down in a big way by big tech. So let's get back now to Racquel Oden. She is head of international wealth asset management and global private banking at HSBC US. First off, have to thank you for your patience. And let's talk a little bit about potentially why we saw such a downdraft. We were walking through some of the potential reasons, and I want to talk more directly about the Fed, because as it stands right now, you have about even bets that the Fed will cut in December, and it feels like that repricing maybe took a little bit of enthusiasm off of risk appetite.
It did. So, I think clearly we do need to celebrate just as much as we celebrated the rocket that the government shutdown is over. And we think great things for the government workers who are getting back and they're getting their paychecks. And so if you are the Fed, right, you are torn. I just told you about strong corporate earnings, and at the same time, you're starting to see parts of the economy still not coming to complete boost. So it is a real 50-50. I will tell you, we are still heavily leaning to a cut in December, but the bets are on both sides of that. Critically important about this, though, is we also are going into a very big spending season. You were talking about Dillard as the winner of the day. Let's take that, right? And the tech stocks not as well. But also, when we take a look at what we expect from consumers for their spending, it actually the stats actually show pretty high results. So we're expecting every consumer to spend about $890 during the holiday season, which is going to be the second highest in history. Last year was around 901. So there is still why you can see the Fed being torn. If you still have consumers who are able to engage and go back to spending. At the same time, you've got strong corporate earnings.
I am curious, though, Racquel, about this idea of kind of where the trade goes next. I mean, we talk about the tech trade, and I just want to point out to our viewers, we are getting earnings out of Applied Materials. They did beat on a couple key metrics, but it looked like they were soft on sales. We're down 3.5% in the quarter. Their guidance also not really all that much, 216 to 220 a share. Street was looking for 215. But it gets to this idea as to whether the phenomenal growth that we were seeing out of these tech names, whether that moderates a little bit, and whether there is enough for, I guess, the consumer side of the economy, if you will, to pick up some of that slack if there is indeed going to be some slack.
So when we take a look, and we've talked about certain particular tech stocks, valuations are pretty high, right, and expensive, right? And so we've got to realize there's going to be definitely some settling. Some people are going to, one, take some earnings out because they can right now. But then secondly, there's still so much of the other tech stocks that do have opportunity. So in all of this, I always see this as a buying opportunity. It's really hard for consumers to get comfortable with that when you're seeing market corrections like this. Guys, 2 days ago, we had a market high of the Dow breaking another record. Here we are 2 days later. To me, this is a buying opportunity. We see long-term viability in the economy, so now it's a great time to be picking up some really great things to continue to diversify your portfolio. And fixed income, right? So we take a look at that, right? So there are certain things where you want to lock in some yields, because if rates are going to go down, this is an opportunity to lock in some yield. So diversification, active management is going to be pretty critical right now because in the short run, there is going to be a lot of this volatility.
Let's talk a little bit more about fixed income. So it sounds like, again, you would lock in here on some of these yields. But where in the fixed income universe are you looking? Are we talking about treasuries? Are we talking about corporate debt? And if so, are you talking about the high yield universe or maybe some more of those
high yield
blue
credit?
chip?
Yeah, you're right. High yield credit, really great. So if you take it, that's around 6% right now compared to you being in a savings account. And there's like the emerging debt markets as well, Asia, Japan, emerging debt markets. So fixed income has a play right now as we're starting to see some exuberance on the equity markets doing some correction, right? But doesn't mean long term. And these valuations were pretty high, right? And quite expensive. So this is, I think, short-term correction that is needed in the market, but also buying opportunity if you take a look at diversification.
Racquel, got to leave it there. Really appreciate your patience and great insights out of Racquel Oden, Head of International Wealth, Asset Management, and Global Private Banking at HSBC. Now, we were just talking about those earnings crossing the wire. This out of AMAT, those shares continue to move lower here in the after-hours trade. The company reporting EPS in the most recent quarter of $2.17 per share. That's down on a year-over-year basis, but a few pennies higher than what the street was looking for. Sales also coming in above estimates at $6.8 billion, so that was still down on a year-over-year basis by about 3.5%. William Kerwin covers this stock or as equity analyst of technology at Morningstar Research Services. William, what was your initial thoughts here on seeing this earnings report? I mean, the numbers aren't awful, but this isn't like the phenomenal growth story that we've been seeing out of NVIDIA and some of the other folks in the chip space.
Certainly not NVIDIA, but we thought these results were okay, especially given that Applied Management set expectations lower after they reported last quarter. So the results came in line a little bit above the midpoint of their guidance, which we think is lightly positive. Looks like the guidance for fiscal Q1 is about in line with our expectations and with consensus. And really, we see offsetting dynamics going on with Applied right now. We see strong demand in leading edge technology for chips. This is really supported by AI infrastructure buildouts. But then we're seeing some growth headwinds out of China, where there were really strong orders in the past couple of years. Those are normalizing, and there are some incremental restrictions. So these are offsetting, creating a bit of a flattish environment in the near term. But when we look at the long-term view for Applied, we think that that AI tailwind is really going to be the larger offset there and be a positive to growth.
Do you anticipate any sort of potential improvement in margins as that story picks up?
We think their margin profile is going to hold pretty steady, actually. You know, potentially some room for scaling on the operating margin level, and that can definitely lead to earnings growing a little bit faster than revenue. But we're more focused on the growth story here than we are in margin expansion.
Talk to us, too, about what we're seeing when it comes to commentary around China, what you're seeing in these numbers, because I know that that was one of the potential concerns you highlighted headed into these numbers.
Definitely. So what we saw is in 23 and 24, there was an enormous amount of excess orders out of Chinese customers that were worried about future potential restrictions of trade between the U.S. and China. Those restrictions, ended up bearing out. But now we're seeing both the impact of those trade restrictions that are cutting off a level of revenue from the likes of Applied and its peers, and a normalization as those customers that were putting in excess orders have to digest all of that capacity. So it's a bit of a two-factor correction here in the China demand. It's been very elevated for a time. We think it's going to go through a correction for a year or two here. But long term, we think that these shipments from Applied that serve non-AI semiconductors, what we call lagging edge into cars and industrial equipment, we think that demand will be stable into the long term once we get through kind of the choppy excess orders and subsequent correction.
The expectation from Bloomberg Intelligence that those restrictions could shrink revenue by about 5%. We'll have to see how that story plays out, William. But, I mean, as we await the earnings call here, when it comes to China, when it comes to some of the other potential cross currents here, what are you hoping to hear from some of these executives?
We're hoping to hear some bullishness on that long-term story. And actually, I caught a quote pretty quickly in the press release about an expectation for what seems like a surge in demand, if I read correctly, in the second half of Applied's fiscal 2026. So that's still a couple quarters away, but that is positive, as I was talking about, kind of getting through this short-term period of choppiness, of a bit of a correction. We can even, in AI customers, see some lumpy order patterns quarter to quarter. So we like to focus a little bit more on where is this going in the next 2 to 3 years. And if I did read that correctly, and there is going to be a surge of demand in the second half of 26, that's certainly positive. I'd like to hear more about that.
All right, William, really appreciate you taking time for us here today. Of course, keeping a closer eye on AMAT. William Kerwin, equity analyst of technology at Morningstar Research Services. Those shares on the back foot here as we continue our coverage. A lot of earnings crossing the wire. We're going to talk about StubHub in just a second. Katie Greifeld, when we come back after the break. I believe actually those earnings crossing the wire right now. I think we can just bring them to you right now. Go ahead.
Yeah, third quarter revenue coming in at $468.1 million. Don't have the comparison there, but revenue also coming in about there, that is. And then adjusted EBITDA, $67.5 million, a loss per share of $4.27. Interesting commentary, too, when it comes to gross merchandise sales, up 11% year over year, excluding the impact of the Taylor Swift's Eras Tour.
What?
They saw gross merchandise sales growing 24% year over year. So interesting commentary there. You can see the stock deciding what to do here. Now, coming up, we're going to stick with earnings, breaking down those StubHub results with Scott Devitt of Wedbush. That conversation up next. This is The Close.
Welcome back to The Close, a down day for markets. In fact, they've been on the back foot really for the last few sessions. You had some bright spots over the last couple of days with the Dow Jones Industrial Average, but nothing really was working today. The Dow down about 1.6%, a similar move lower for the S&P 500. The NASDAQ, really, anything with tech in it really got hammered today. The NASDAQ indices each down about 2% on the day. We should point out that the Mag 7 as a group also moved lower, down almost 3% on the day, with the big drag coming from NVIDIA and Amazon, each down about 3%. And the Russell 2000, if you were expecting, Katie, a rebound in small caps, you weren't getting it today. That also dropped about 3% on the day. The VIX elevated, treasuries stuck in a somewhat tight trading range.
Let's take a look at some of the individual movers on the day. I wanted to highlight some things that did work, and one of them was Berkshire, up about 2%. No clear reason why, but one of the biggest moves to the upside on a points basis in the S&P 500. Cisco, we know the story there, of course, reporting earnings yesterday, well received by the market, sending Cisco shares up 4.6%, and certainly the bar was high for this company. Looks like they managed to clear it. NVIDIA, though, one of your biggest losers in the S&P 500 on the day. One of the big reasons why you saw such a downdraft in market. NVIDIA shares lower by about 3.6% on this Thursday in the normal session. But let's take a look at one of the biggest movers after hours. StubHub, of course, reporting results just in the past couple of minutes. Let's break them down now with Scott Devitt. He is equity research analyst over at Wedbush, joining us now. Scott, great to have you. This is a company that only went public in September. They've had a really rough reception by the equity market. It doesn't look like it's getting better right now when you take a look at some of these numbers and the reaction in shares. What's your first reaction?
Well, it's a tough day to report earnings, right? So reactions tend to be negative on a knee-jerk basis. But I thought the quarter was pretty good. She mentions the first quarter as a public company. The company went public at $23.50 about 2 months ago, and exceeded expectations in the quarter. You know, there's no information in terms of forward guidance, so that possibly comes out in the call. That'll be important. I think that comping the Taylor Swift New Eras Tour in December of this year, we'll start to get the reported results to look more consistent with that adjusted number that you referenced earlier. And then, 2026 for this company is going to be continued growth in the core business and the build out of its direct listings business to try to compete more directly with Ticketmaster.
Yeah, well, let's talk a little bit more about what you do want to hear on the call, given that it is their first earnings report as a public company, given that it doesn't look like we have the guide ahead here. Numbers aside, I mean, what do you want to hear from this company and from its C-suite?
Well, the core, secondary ticketing business is very stable. StubHub's been taking share from some of the smaller competitors on the back of the implementation of all-in pricing this year. And so the continuation of that, I think, is important. But probably the most important topic is going to be this direct listings business, which is just starting out for StubHub, but it's going to be potentially a significant driver of growth in coming years. And that's where they're beginning to do deals with venues, teams, and leagues to get access to more primary ticketing inventory and like I said, compete with the Ticketmaster monopoly.
I know there's been a lot of talk about some of the big sporting events and how that could actually potentially be a boon for StubHub and for its competitors. We talk about, obviously, the Eras Tour helping as well in the past. When you look ahead, particularly to the big World Cup coming up, as well as some of the other events, Scott, I guess the question is, do we start to look at this company and the stock as something that is a little bit beholden to the sort of live event cycle, or is there something that's going to be, I guess, can smooth that out so that investors have a little bit more predictability about what comes next?
Well, there's some things that can't be smoothed out, and that Taylor Swift event is one of them. And otherwise, I think that any, single event, you're going to have instances like World Cup, Olympics, things like that do drive the business. But what you're really focused on here is, I think, consumer spending. And this is a company, that's tied to the success of the consumer. So if the consumer holds up, StubHub does well. If we go into more of a recessionary environment, then I think a company like this is challenged. And keep in mind, that Taylor Swift does have a new album out, so it's very possible you could get a lift from that, in 27, 28 if there's another tour. So that's something that's not really in the stock, but could come in the future.
Oh my gosh, I think I speak for quite a few Americans. No more Taylor Swift tours. I'm sorry.
I think you have the other side sitting next to you, but I'll let you continue, Romain.
Yes, we debate here. We have a lot of Taylor Swift lovers in this building for some reason, Scott. In all seriousness, though, I am also curious about some of the issues in Washington with regards to the investigation into the practices of ticketing companies. And I know StubHub wasn't directly the target of the most recent round of investigations, but is this something that investors should at least be mindful of?
Sure. It's an industry that has a small number of competitors, and particularly on the primary side, which is what you're referring to most recently. But I think that, anytime you have an industry with less fluid competition, there are more actions by those companies, to maybe maximize profitability over being consumer centric. And so I do think that oversight, it's a risk to the industry. It's not necessarily specific to StubHub, but always something to pay attention to.
I do want to just talk about, why this is a company that needed to go public. And you think about the IPO drought that we've been in, probably shouldn't complain or question companies deciding to go public. But it's a relatively small company, Scott. And again, you take a look at the reception, it has just been brutal. I mean, year to date, again, which is simply just since it went public in September, the shares are down nearly 20%. They're down another 6.5% right now. Do you think this is a company that maybe should have waited a little while to actually tap into the public markets?
Not necessarily. This was part of a public company in prior years. It was part of eBay before it was sold and taken private and then taken public again. It's a $6 billion market cap. It's a sizable business. It's a very relevant company in its industry. So I think very much so, it deserves to be in the public light and is definitely an investable asset. The questions are, in terms of the volatility in the stock, are because a lot of the growth that is to come in this business hasn't developed yet, which is this direct listings business. And you have that difficult comp that was referenced in the press release related to the Eras Tour and the all-in pricing that was implemented this year, which is a complicated topic, but something that affected the whole industry and was forced on them by the government.
All right, I have to leave it there. Scott, appreciate you taking time for us. Scott Devitt, equity research analyst over at Wedbush. Those earnings out of StubHub. StubHub, one of the biggest decliners in the after-hours trade. Meanwhile, one of the biggest gainers in the after-hours trade is Beazer Homes, up 10% on the back of its earnings. Revenue in the quarter that beat mightily, $792 million. The street was looking for only $6.79. And on EPS, on a continuing basis, $1.02 per share here, which also looks like a bit of a topping of estimates.
So keeping an eye on those shares. Let's also talk a little bit about Whirlpool, up by about 3% right now after hours. That's after we got the 13F filing for the third quarter from Appaloosa, apparently boosting their stake in Whirlpool. A few other names as well, NVIDIA among them. Also, Appaloosa increasing their stake there. In terms of what they reduced, this is interesting. They reduced UNH, also Amazon, Meta, and Uber in the third quarter. Again, this is their 13F filing, so it's a little bit stale, but interesting to see the different bets that they took on and took off during the quarter.
Yeah, one of the big movers in the after-hours trade. When we come back, we're going to talk about what happened in the cash session and the big drop that we saw in Disney, lacking the magic touch with the shares streaming lower on those underwhelming earnings results. We're going to catch up with Ross Gerber over at Gerber Kawasaki when we come back after the break. This is The Close on Bloomberg.
I thought it was a good quarter overall, and frankly, versus Wall Street, we beat expectations by 6 cents. So, as you noted, the experiences business did very, very well. 6% revenue growth, 13% OI growth was terrific. Apples to apples basis. Overall, I thought the quarter was good, and it actually allows us to end the year with a lot of momentum.
Well, Disney investors not buying what the Magic Kingdom is selling. Shares streaming lower after a fourth quarter revenue miss and a forecast some called, quote, underwhelming. Joining us now is Ross Gerber. He is CEO, president, and co-founder of Gerber Kawasaki Wealth and Investment Management. So, Ross, let's talk about this. I know that you have owned Disney. You do own Disney, but you've lowered that stake a little bit here. When you take a look at the reaction to Disney shares falling nearly 8% today, is that a dip you would consider buying?
Not in Disney shares currently, no. And there's many reasons for it. But, you know, it was also a pretty negative day for stocks overall. So, you know, Disney was probably hurt worse because of that. But in general, they're still struggling with the two main issues that they are trying to address. Number one, that linear TV continues to just, you know, get decimated quarter after quarter. It seems like it'll never end. And so they've got streaming now profitable to help offset that, but you're still working with a gain in one area and a loss in another area, and it's kind of working out to be even. And then the second part, which is I think the reason why the stock's down, is that the content they're making just has not been as good as in the past. And their hit and miss content creates choppy quarters, and it creates variable results. Because the way that the Disney hit machine used to work was they would have a great Marvel movie and a great Pixar movie guaranteed every year, and that was like a couple billion just in the bank. And now what's happening is that is not happening at all. And so the Marvel movies are stale. They've done 100 Star Wars movies. They're stale. They just like have nothing really driving the type of IP enthusiasm that was created in some of the other movies that we've seen this year, for example. Right. And I just think it's really hurting Disney.
Yeah, I heard Matt Miller make the point on Bloomberg Television this morning that you think about some of the movies that they have coming up, basically all of them are sequels here, Ross. It sounds like you're not taking a lot of comfort in what we saw with more of their in-person experiences when it comes to parks, when it comes to cruises.
Well, I thought those numbers were actually quite good, actually. So I was actually more concerned about parks and resorts just globally with tourism and spending, but we didn't really see a decline there. So I was actually pretty happy. And parks and resorts and experiences is a great business with a huge moat. But where they were really hurt was in the content and the licensing, where that was down 29% revenue-wise. And, you know, once again, that's making movies, and it drives everything in the Disney kingdom. And if you're not making new hit movies, it's really hard because you're just selling the same IP. You know, how many avatars am I going to buy for my kids? You know, it's like, they already have it, you know? And so...
Well, that's one thing I'm curious about, Ross, too, is also, I mean, I don't think anyone doubts the strength of its existing IP, but there's also been a lot of discussion about creating something new, right? I mean, it's one thing to just keep rebooting the same stuff, but when am I going to get the next Disney classic that is going to lead to new IP, new characters, if you will?
Yeah, and I think that's what they call, you know, the magic of Hollywood, which isn't really a quantifiable thing. You know, sometimes you hire the best people and they make a crappy movie. Sometimes you hire a bunch of nobodies and they make a great movie. But we saw this with the K-pop Demon Hunter with Netflix. They didn't expect it to be such a big hit out in the theaters, and it went out and killed it for them. And that's the kind of IP that you used to see at Disney. And so you see other companies, Paramount, Skydance, you know, ironically, you know, John Lasseter left Disney because of the issues he was having, and he went to Skydance, and Skydance has made some great stuff. So, you know, the guy is a tough guy to work with for various reasons, but he was also the creative force behind Pixar, and at some point you have to accept that you lost that. And so I don't know where they go. You know, it's a very competitive business for IP now that used to only have 3 or 4 players, and now you got like 8 players, and they all have tons of money. So it's a hard business to be in now.
I am curious, getting to that idea of the hard business, about who's really going to run this company. We should point out we're basically at the 3-year anniversary of Bob Iger's return to the CEO chair. And they said today that they are going to make a decision, an announcement, hopefully by March of next year, of who his permanent replacement will be. I guess, A, do you think we actually will see a replacement for Iger sometime soon? And two, who do you think would actually be best for that role?
Well, they've pretty much said, this is going to happen. So I do still see it happening. And who I think is best for the role is none of the above. See, the problem with Disney is it's basically 3 or 4 very different businesses. So running parks and experiences is completely different than running the linear cable business versus the streamers versus the sports business. So You've got all these different businesses with different heads that are all good at their jobs, but none of them have that unifying power across the other businesses like Iger has.
Yeah.
And this is the problem that Disney has. They have great leadership in each division, and they're all vying for this CEO job. But what I fear is none of them are capable of running all the divisions. And we saw this with the Jimmy Kimmel disaster. Just a lack of decisive management decisions and a lack of bravery on Disney's part, because they don't have that kind of leadership coming up that should be, really one person or 2 people who are extremely capable and decisive leaders. And that's what Disney needs moving into the next chapter that they have. And I don't think they've found that yet.
Well, then based on what you just said, though, is there an argument to be made that maybe these 3 big units shouldn't be together under one umbrella? I mean, there's been a lot of talk about whether they should spin off at least maybe the TV business or something. Is that not something you would be supportive of?
Well, Comcast is, sending their linear cable businesses off sort of onto this Versant ship to nowhere, and that's one way to sort of pretend like it's going away, is just spin it off. You can't really spin off linear ABC because they're really using that same content with Hulu. So that's part of the problem, So the whole breaking up of Disney and selling off the parts would probably lead to about $150 to $60 value, but I don't think you would lose something in doing that. So the only business I see that they could spin off is ESPN as a separate app and as a separate sports business, and that might be able to create some value for Disney. But it might not either. So I don't know if that's the solution. Yeah. And that I think is the challenge. Is Disney is it's a bunch of great assets that, quite frankly, are just not being maximized in its current form. So I see a better outcome for Disney being sold to Apple. Apple obviously will not make the type of decisive decisions to get into content in a major way by buying something like Disney. But for the amount of money, and the valuation of Disney and Apple, this would be a game changer if they really wanted to be in entertainment. So, it's a big thing to bite off, but you could sell off the parts you don't want. So I don't know. I think Disney's in play. I think somebody should buy it and break it up.
Okay, well, on that thought, just hold your horses for 1 second, Ross. We are getting some breaking news. This is coming out of the Wall Street Journal, and it involves the potential bidding for Warner Brothers. We're now learning, according to the Wall Street Journal, citing people familiar with this situation, that Paramount Skydance does plan to bid for all of Warner Brothers, but that Comcast and Netflix are also preparing bids for Warner Brothers itself. It says that Netflix and Comcast are each pursuing Warner Brothers either as a whole or in parts, with the studio and streaming potentially as separate.
Yeah, fascinating to see the reaction in shares of Warner Brothers in particular, up about 3% right now. You aren't seeing much of a reaction in Paramount, but Ross, let's bring you in on that conversation. The idea that Paramount potentially going after all of Warner Brothers, not going after it in parts here. I mean, what's your reaction?
Well, it's funny because I just spent a lot of time with a lot of people who are pretty up there in Hollywood and trying to get a sense of where the future goes. And, they were trying to get a sense from me of where technology is going and how this will affect their businesses. And what I heard from everybody is everybody's very bullish on Paramount Skydance and what Ellison is doing, and they have sort of an unlimited pockets to do stuff. So when he started looking at Warner Brothers, he wanted just the studios, but Zaslav has a ton of debt, and he can't just sell the studios off, which is the most valuable part, and be stuck with the debt and the cable channels. So So he wants to sell the whole thing, but it's got a ton of debt. It's really expensive to buy Warner Brothers as a whole. And so what I think Comcast and Netflix are doing now is going to make it really hard for Paramount to do this and very expensive for them, because I don't think they want Warner Brothers at all, or they would have tried to buy them earlier. Yeah. So, basically Ellison's got himself into a pickle, because they know if they let him have Warner Brothers too cheap, then it's a real competitor to them. A lot of people in Hollywood think that Ellison and this Paramount and Skydance is going to be like the next Disney, you know? And so people are scared of him, and they're going to make it very expensive for him. And that's why I bought some Paramount, and then I just sold it, because I don't want to be in this bidding war stuff for assets with tons of debt in a very difficult business right now. And I think Netflix is the play, and that's one of our top holdings.
All right, Ross Gerber, CEO, president, and co-founder of Gerber Kawasaki Wealth and Investment Management. We should point out Warner Brothers, which closed in the red in the cash session, up about 3% in the after-hours trade. The Wall Street Journal, to Ross's point, reporting that Comcast and Netflix only are interested in the movie and television studios and HBO Max, not the cable networks like CNN and TNT, though Paramount is said to be bidding for the whole shebang. Bids, first-round bids, due November 20th. This is Bloomberg. All right, the Related Group is one of the country's largest real estate conglomerates, a huge presence down in South Florida. And we had a chance to catch up a little bit earlier today with the CEO and chairman, Jorge Perez, who talked about the future of the company and the future of the real estate industry.
Since after COVID, we've had huge demands from cities like New York, Boston, actually even California. And we've also continued to have a very strong South American market. Miami is sort of like the capital of the Americas. And our condominium sales, are not in the frenzy of the 2020, but this year we've already sold around $1.5 billion. We just got some numbers, some $300 million in the last 60 days. So our market continues to be very strong. We've taken advantage of that market. And, the number of units that we're building, is not just in Miami, but in Tampa, Fort Lauderdale, West Palm Beach is growing, tremendously. The new areas like Pompano Beach, are growing. So we're seeing, an overall continuous growth, both in South Florida and the rest of the markets that we're in.
You've benefited a lot from migration that we've seen out of places like New York City, even Los Angeles, down to other areas of the country, primarily Florida, South Florida to be specific. Do you see that trend continuing?
Yes, very much so. We have a government that is pro-business. We have a great, not only in South Florida, but the state government is trying to increase, the population, the businesses, and so forth coming to Florida. So, we're putting, not 100% of the eggs in one basket, but we definitely, the majority of our investments over the next decade will be in South Florida. We do not see a slowing down of that exodus from older cities, but, more tax-impacted cities. Cities with, greater social problems, homelessness, and so forth, that continue to come down to Miami. The calls that we've had recently have been, incredible. Both in companies, looking to, for office space and coming down, and people buying both second homes and permanent homes here.
What is sort of your cost structure look like right now with regards to finding the workers to help build your properties, but also the materials and all the other costs that go into that? Are you still seeing elevated prices in those spaces?
Yes, and you mentioned it perfectly. There's two issues, right? With the increase in tariffs, we're seeing already increases in the materials that we use for construction, and with the enforcement of immigration, both the actual and the perceived enforcement of immigration has had an impact in the construction industry, not as much as it has in the, for example, the restaurant or hotel business. But many of our workers are, foreign workers. We don't do surveys of how many are legal and illegal here, are subcontractors. But I know a lot of the people when I go there are from other countries. So we've already seen some shortages on labor supply, and again, some increase in prices. So, but what it means to us is the existing product, the product that we're selling today, is going to look extremely cheap in the coming years, for three reasons. The two that we just mentioned, the impact of labor if we continue, with, the immigration policies, the tariffs. And finally, South Florida is not like 360-degree cities like Atlanta is, for example, or Kansas City. We have the ocean on one side and the Everglades on the other. So prime land is becoming almost impossible to get. Most deals today require buying old buildings, condominiums, one by one, in order to, to create new product. And that, of course, increases the prices of the real estate tremendously.
Do you think Related Group will expand a little bit more beyond South Florida because of that? I know your sons have been trying to make some waves of their own as they kind of take the reins of the company.
Yeah, look, we have done that. We're always looking at opportunities. We have like 7 or 8 projects going on in Mexico, extremely successful. We did just start completing 5 towers in Sao Paulo, Brazil, which are 98% sold. We finished 3 towers in Buenos Aires, Argentina, all sold and all have done extremely well. And we have projects in the Atlanta area, in North Carolina, Texas, both Houston and Dallas, Phoenix, and all over Florida, right? So yes, I think the company will continue to expand, We're very strong financially, which allows us, and we have great partners, so all we need to do, thank goodness, is pick up the phone for both lending and equity if we need it.
Jorge Perez, the CEO and chairman of the Related Group, Katie, which he founded back in 1979 after immigrating here to the U.S. in the late 60s.
Yeah, great conversation there on the state of real estate and on South Florida. And coming up on the close, a showdown brewing at Starbucks with more than 1,000 baristas staging a walkout. We'll talk through the impact next. This is The Close.
Workers at Starbucks locations, about 65 of them across 40 U.S. cities, have staged a wave of walkouts. This on one of the company's busiest days of the year, Red Cup Day. The halt could grow to become Starbucks' biggest strike to date, according to Workers United, the union behind the strike. Let's bring in Michelle Eisen, bargaining delegate and barista at Starbucks Workers United. We should also point, she was a member of the very first Starbucks store to unionize up there in Buffalo, New York. Michelle, I know this is day one here, but a lot of people want to know how far you're willing to take this. What exactly do you want from Starbucks that could bring the strike to an end?
Well, workers are committed and ready to take this as far as they need to in order to secure a fair contract and an end to Starbucks' egregious union busting. It's 1,000+ workers today in over 40 cities, and workers have authorized an open-ended strike, the first in our campaign's history, and that means they are willing to escalate accordingly. Starbucks needs to return to the bargaining table with new proposals that are going to solve the remaining demands. Those are more take-home pay, better hours to fix the severely understaffed stores, and to resolve the outstanding unfair labor practices, of which there are hundreds hanging over their heads.
Well, Michelle, talk to us about what Starbucks' response has been so far, and what is the current state of play when it comes to negotiations?
Starbucks has not responded to the union directly at all, to the best of my knowledge. We made repeated attempts to get them back to the table over the last 6 months. The last face-to-face was in April of this year, where Starbucks responded to the union's economic demands with an offer of nothing. And I'm not exaggerating.
Yeah.
And we've made repeated attempts. including asking Brian Nickel himself to join the negotiations in order to hope that things could get moving along. Finally, workers were fed up.
Yeah. Well, I'm curious on that point. I had a chance to catch up with Brian Nichols a couple weeks ago about this issue. And, he obviously talked a lot about some of the new things that he's trying to implement in the stores. And a big part of that is on service. And that, of course, means retraining employees, getting them on board with some of these changes. I do wonder how much of some of those changes that he's brought to the table in the year that he's been on the job have fed into the strike that we're seeing today, which I know some of the issues predate him, just to be fair.
I mean, all of the policy changes that have rolled out under Brian Nickel have only made baristas' jobs more difficult, and they have yet to actually improve the customer experience or the environments in these cafes. You can't heap additional responsibilities onto these already understaffed stores without increasing the staffing. And we have not seen any substantial increase in staffing in these locations.
Michelle, I have to leave it there. Michelle Eisen is bargaining delegate and barista at Starbucks Workers United. An open-ended strike, Katie Greifeld, as she pointed out here. This is the first ever, so this could drag on for quite some time. I was trying to look it up. The only big strike they've had in the past was a single store in Boston that I think was shut down for or they were walked off the job for 60-something days. So
yeah, and it'll be interesting to see how leadership navigates this. Of course, Brian Nickel still relatively new to the CEO chair, and certainly you said that there's only been one big strike, one store in the past couple of years, but we know that these issues have been percolating for a while when it comes to the workforce.
And we should point out 65 stores involved in this. We're talking about a store that has, a company that has 40,000 stores worldwide, 16,000 or so, I think, in North America alone, but certainly symbolic in nature. All right, that does it for us here on The Close. Katie and I will be back tomorrow for all of your market moving action. I don't know if you heard, Katie Greifeld, but the government has reopened.
Theoretically.
A lot going on in Washington. Joe Matthews coming up at the top of the hour with Balance of Power for all your news from there. This is Bloomberg.